Thank you all for joining us today, and I hope today finds everyone safe and well wherever they are hunkered down at this point. As Vlad said, I'm with the investment management firm of BlackRock, and I've been with our firm for a while, actually not almost, just over 25 years, last week, in fact. And in my typical role normally is I travel around the country and do events like this, in person. So unable to do that today, obviously, but through technology, we get an opportunity to do these things virtually, and quite frankly, it's kind of fun. So, our topic, is around the psychology of investing. But before we actually get into the meat of the presentation, I just wanted to give you a little bit of an overview, or kind of a rehash of some of the things that that we've experienced during this crisis over the last couple of months or so. So, outside of the virus itself, market volatility literally has been the defining feature during the crisis. And during the last couple of weeks, and interestingly, we had a stretch of 8 consecutive days where the stock market moved up or down by 4%. And that had never happened before in history. In fact, the previous streak, you had to go way back to November of 1929 for just 6 consecutive days. Even as volatile as 2008 was with the financial crisis, we only had 4 days in a row when the market moved up or down by 4%. So literally, this volatility is unprecedented. A couple more kind of interesting points. Back on March 16th, not that long ago, March 16th was the second worst day ever for the stock market since 1950. It was down about 12%. But 6 days later, on March 24th, was the third best performing day since 1950. And, this is what we've seen historically, is that the best days and the worst days of the market, they tend to kind of cluster together. Now, the challenge for us as investors, especially during a volatile period like now, is that if we sell following some of these worst days, there's a good chance we might likely miss one of the best days on the other side. And we're going to talk about that a little bit more in a few minutes. Now, BlackRock, and when talking with Vlad, we like to lean in on history a little more to kind of get a better understanding of the market typically has responded following these extreme type moves. You may want to think about it as using the wisdom of Mark Twain, who once said, history doesn't repeat itself, but it often rhymes. So let's share a few more interesting statistical numbers over the last couple of weeks. If you're looking at the 15 worst days since 1950 for the stock market, the average decline was almost 9%. But over the next 12 months, the market was up on average 24%. During the crisis, we've actually had 3 days that would qualify as one of the 15 worst days ever. The worst day, though, was October 19th, 1987, Black Monday. Remember, the stock market was down over 20%. I remember it because it was the weekend after I got married. But the next year, the market was up 23%. You can do this looking at months, the 15 worst months as well. March was the 4th worst month since 1950. But on average, 12 months later, U.S. stocks were up over 20%. Quarters works very much the same way. So since, as investors, it's nearly impossible to time the bottom of the market perfectly, it's good to know that historically you don't have to. Since 1950, had you missed the bottom of the bear market by 2 weeks, either early or late, you still averaged over 20% over the next 12 months. This is a good time, right, within this volatility to spend some time talking to Vlad, talking about rebalancing or partially rebalancing your accounts in these difficult markets. A typical diversified portfolio uh, prior to the last couple of days was down about 12.5% during the crisis, while U.S. stocks were down 19%. That's actually shrunk pretty significantly in the last couple of days as the market's been pretty good. Limiting losses, right, during these difficult times is really kind of critical to our investing success. And there's really power to it, right? And it's why we build portfolios the way we do. At BlackRock, we like to refer to it as winning more by losing less, right? Think about that. Winning more by losing less. We don't necessarily need all of the upside of a bull market, but if we can get a chunk of that upside and do better in difficult markets like now, we believe we can do just that, win more by losing less. And with that kind of as our introduction here, kind of a highlight of the last couple of weeks, let's jump into our topic and tell you how this kind of comes together. In the program, we like to call psychology of investing, right? Or why we, can be our own worst enemy. So what I want you to do on our next slide, and I'd love to be able to have done this in a poll, but we're going to kind of share the data with you, are 4 investments. So I'd ask yourself, if you could only pick one of these 4 investments, which one might you pick? That orange line going up and down there, the green line that has some ups and downs as well, the pink line that goes up, pretty consistently, or the yellow line down there at the bottom. Now, I can share with you, and all the times we do this program, when we poll people and ask them, about 85 to 90% pick that pink line, right, as it gradually and steadily goes up over time. But what I'd like to do is share with you what those actual investments were. Right, the orange line was Pfizer stock, right? The U.S. stock market is our green line. U.S. Treasury bills down at the bottom, as we would expect, right, is our yellow line. But the pink line, the one that almost everybody selects, is Fairfield Century. Now, if you're not familiar with who Fairfield Century was, it was actually the feeder fund for the Bernie Madoff scandal, right? So one of the worst financial scandals in our country's history. So it just kind of reinforces that from a human nature, right? Looking at that pink line, it looks pretty good, maybe too good to be true. And in reality, right, if something's too good to be true, it usually is. It turns out to be the worst opportunity there. So when we think about what is actually the key to financial success, and people ask, oftentimes they think from an investment standpoint, they want to, follow taxes and estate planning. And next building block is our asset allocation and ultimately our security selection. But the foundation, really the key to investment success, is the bottom of that pyramid. It's our behavior as investors. Investor behavior is the key. You can have the most perfect asset allocation or security selection, but if you're not disciplined in your investment process, you could ultimately run into problems down the road. And oftentimes when we talk to people, people think, you got to be really smart, right, to invest your money. And actually, you don't have to be really smart. You just have to be disciplined. I share an example with you. Isaac Newton, as you may remember, Albert Einstein called him the smartest man in the history of the world. You may remember him from school as creating calculus, right? The new math, physics. Developed the telescope, excuse me. But he was also an investor. And back in 1720, Isaac Newton lost a fortune, 20,000 pounds, investing in the hottest stock of the day. It was the South Sea Company. Now, losing 20,000 pounds in 1720 would be like losing 3 million pounds today. And after that experience, Newton concluded, right, that he, can calculate the motions of the heavenly bodies, but not the madness of people, right? Now, if we want to bring a more current, let's say, analogy to our conversation, we can refer to Warren Buffett. A lot of people like to do that, who said, hey, we don't have to be smarter than the rest. We actually have to be more disciplined than the rest. And that leads us into, our agenda, what we want to focus on from an investment standpoint, or a couple things we want to try to avoid, right? Or think about and define here. First is envy and what that really is going to mean as investors for us. The second is loss. And the third ultimately is building discipline for the long term. So let's start with number one here. Let's talk about envy. And there are three different categories of envy. Millennials out there might call it FOMO, right? The fear of missing out. But we're going to focus kind of on three areas here. We're going to talk a little bit about regret, the lottery ticket event, and ultimately miscalculating some of the risks that we focus on as investors. And here's a study that is actually outside of the investment market, but I think it's really kind of interesting. It was actually done on Olympic medal winners and surveying medal winners on their happiness. And as you would expect, right, the gold medal winners were the happiest. But what turned out to be interesting was that the bronze medal winners on average were happier than the silver medal winners. Now, why is that, right? And for the silver medal winners, it's that regret, it's that fear of missing out, being that close, right, to that gold medal. But on the flip side, the perspective of the bronze medal winner oftentimes is, they're happy that they were actually on the podium, right? They might have been off the podium with a little slightly less performance, right? So again, it's your perception ultimately that can drive happiness. But when we think about this from an investment standpoint, it brings us to another topic. BlackRock, we refer to it as S&P envy, right? Thinking about our diversified portfolios. Now, if you have a diversified portfolio, and I'm sure many of you on the call do, you probably ask yourself that over time, a good one doesn't really feel good, right? It never feels like it's winning. So here's a couple of examples looking at a diversified portfolio over time. I'm taking back to the top of our chart. We're going back to 2000, 2002, and you look at that diversified portfolio with a negative 18.6 return, lost almost 19%. So you're sitting there in that account, and you lost money, right? So when you think about it from a typical standpoint, in a bear market, a diversified portfolio is going to lose money, right? But in a bull market, you're going to underperform. You're going to trail the index, and both of those never really feel very good. 2003 to 2007, diversified portfolio returned almost 74%, but it underperformed the S&P 500. And again, you're sitting there going, I didn't make as much money. It's that envy to what the market performances were. 2008, one of the worst time periods for a diversified portfolio. But then when you bring it towards 2009 to 2019, the bull market, again, you trailed the index. But the kicker here is at the bottom, that when you add all of these periods up, it turns out that the diversified portfolio actually outperformed the market over time. So think about that aspect of how the account actually performed, and we literally see the same thing here going on during the crisis. A diversified portfolio has outperformed the performance of the market since the crisis has began, even more dramatically the last couple of days. Next, we want to talk about the lottery effect. And if you think about the lottery, there is Americans spend on average $233 per person on the Powerball lottery tickets, right? Even though the odds of winning are 1 in 292 million, right? So when you think about that, the lottery effect is a small investment with a huge payout, right? But the odds of getting that payout are really, really slim. Translating that to the investment side of the market, the implications are investing in single securities, putting all of your eggs in one basket, right? again, from a portfolio standpoint, may not necessarily be the right idea. Or looking for that next great company, trying to find that next Google or the next Amazon, right? Or that hot investment trend, Bitcoin, might be an example of that. Now, I'm not saying that a single security doesn't make sense in a portfolio. Oftentimes it does, right? But it has to become part of a balance of that overall portfolio structure. Too many eggs in the basket, right, ultimately can be a problem. And you can see this when you look at how stocks versus mutual funds have performed. In the last 5 years, right, the U.S. stock market was up 8.5%. But when you look at the individual holdings, individual securities within the market, 38% of them lost money over the last 5 years. But if you look over to the right, when we talk about U.S. mutual funds and ETFs, 97% of those products had a positive return over the last 5 years. Only 3% lost money. So once again, it's kind of reinforcing that lottery effect as a component, as a risk factor we want to try to avoid. The next slide is kind of recognizing how severe these risks can be over time. And one of the things I think is kind of interesting here, and it's tough to do math right in a conference call. And I think we all kind of maybe remember this from grade school, but it takes a little bit of rehashing. And our slide is built out here, so the punchline is already included here. But if you look in the gray box at the top, right, if you start it with $1 and you lost 50% of it, how much would you need to gain back to have that, to break even, to have that dollar, right? And that answer becomes 100%, right? That all makes sense to us. But if your portfolio is down just 10%, the return needed to break even is 11. But if you carry that out further to the right, losing 60% or 70%, the amount necessary to get back to break even, right, is really, really significant, 150 to 233% in each of those examples, right? Reinforcing winning more by losing less over time and recognizing the value of diversification and understand what those risk kind of components can be. Next, we're going to jump into our second section here. We're going to talk about loss, right? Breaking it into 3 areas: the tendency to act as a human behavior, sideline sitting, and ultimately following the herd here. Before we kind of dig into those, one of the examples that we want to pop up is a lot of stuff is coming across, our TV sets, our mobile devices, right? The news. It's, if you look in the afternoon at CNBC in the afternoon, their 2 most popular shows are Mad Money and Fast Money, right? And when you think about those programs with those headings, what they're really designed to do to gain viewership is to drive up anxiety and fear, right? Anxiety and fear leads to more clicks, means to more advertising, means more revenue, etc. So when you're watching these programs, at some time you've got to think about maybe disconnecting a little bit to try to avoid some of the angst and anxiety that gets here. A couple of nights ago, here at my house, we had a thunderstorm rolled in over the night, and as it was coming through, the power went out. And as the power went out, my wife and I were thinking about, oh my gosh, how are we gonna, be able to function here? Where we're getting all our news, how we're doing webinars and Zoom calls and all of that kind of stuff, and how are we going to function if we have no power? Can't check our email, etc. What we did actually is, we were thinking about this. We were looking out the window and actually kind of watching that storm go by, and it actually kind of gave us an opportunity to sit back, take a breath, kind of relax a little bit, and think about some of these things. Disconnecting from time to time can be an answer. And if you really have some anxiety, well, that's when you pick up the phone and you give Lad a call and you ask him, hey, what should I be feeling? How should I think about things? But when things go bad, when there are problems, right, it is human nature to actually try to fix those problems, right? It is our behavior. It's an action response to do something. And another study outside of, again, the investment world, back to the sports world again, is looking at a soccer goalie. And if you can imagine a soccer goalie standing in front of his goal, defending against a penalty kick. It's just the goalie and the kicker and not a lot of space and a big wide net. And statistics that show that the best strategy for the goalkeeper is to stay right in the middle, right? But statistically, a high percentage of the time, right, the goalkeeper will jump either to the left or to the right, right? So there is that tendency to action, that action bias. So we're not saying here that you should always, right, not take an action in a crisis or to fix a problem, but recognize that action for action's sake may not necessarily be the right approach when it comes to your investments or stopping a penalty kick. Bringing that back to an investment discussion brings to another phrase we like to use at BlackRock as the heading for our slide, which is time in the market versus timing the market. So this slide here shows you investing $100,000 in the S&P 500 over 20 years from 2000 to 2019. And if you look at our orange bar there, you started with $100,000, you'd have $324,000 at the end of 2019. But if you had missed the 5 top performing days for the market in that 20-year period, you just missed 5 top performing days, you look at the significant decline there in the value of the account, $214,000. Taking that out, if you missed the 15 top performing days of the market, right, down to $127,000. And if you missed 25, the top 25 performing days of the market in 20 years, missed the top 25 days, you actually lost money in the account, right? So why is that? Because over this 20-year period reinforces what I said before. The worst 25 days of the S&P 500 performance, 24 of 25 of those days were within 1 month of the best 25 days, right? So again, we talked about how these best and worst days tend to cluster, and reinforcing it as time in the market, not timing the market. Again, discipline to our investment approaches. Sideline sitting, right? Reinforcing having cash, right, within our accounts. Cash is at historic levels. And also, we know, right, with Fed cuts to interest rates, great for our mortgages, right, but not great for our savings accounts, right? So having too much cash can also adversely impact the performance of your account. And back to Albert Einstein again, if you remember, Albert Einstein was also famous for another quote. He referred to compound interest as being the 8th wonder of the world, right? So waiting for the right time to invest your cash ultimately can leave you behind from a performance standpoint. Again, something to think about as you evaluate the diversification of your portfolios. Herding is another area where, from an investment standpoint, behaviorally, we can get ourselves in trouble. And when you think about herding, you know, it's oftentimes, it's just that, it's following what others can do, following the crowd. I have my little Penn State mug here, and I think about a perfect example of herding is when I'm up for a football game in State College and you're downtown and people need to get to the stadium and you just start following people. You have no idea where they're going, but you're just following them, hoping they're going to get you to the right place, right? But following a herd in an investment standpoint can be a problem. So this slide is actually looking at 3-year average performances for the S&P over a pretty long period of time. And the average return for all those periods is that dotted line there, 10.1%. But investors that followed the herd, that means they were buying when others were buying, actually underperformed the average, 6.7%. But yet investors on the flip side who were buying when other investors were selling actually outperformed the average. Let's look at some specific time periods. The quarter with the most buying, when most people were buying here, was the fourth quarter of 2000. That was right as the tech bubble burst. And over the next 3 years, U.S. stocks performed a negative 11%, right? To the right, the quarter with the most selling was the first quarter of 2009. It was right at the end of the financial crisis, and the market returned 88% positive over the next 3 years, right? So again, following that herd may not necessarily be the best advice. Or once again, as Warren Buffett like to put it, be fearful when others are greedy, right? And be greedy when others are fearful. And that really kind of summarizes our thoughts around building some investment discipline, right? Working with Vlad and the team of advisors to make sure that you've developed the right allocation to meet your goals, and from a discipline standpoint, standing there and getting there. And part of those discussions oftentimes is around the creation of investment policy statements or a derivative of such, where you say, hey, what is the plan in certain component pieces when the market is going to go up or down? You know, what is our process? What are we going to do? What is our rebalancing schedule? How does that work? So you're actually equipped, right, in periods like this to combat your emotions when things fall, because you know what your discipline process is ultimately going to do. Forecasting, once again, reinforcing turning off that financial and TV news. I really like this slide because it is a really long-term study that was done by the Federal Reserve of Philadelphia, looking at a really long period of time where they were asking financial professionals to predict the movement of interest rates, U.S. Treasury bond in particular. And when you think about it, you flip a coin, right? A coin flips 50%, right? Heads, tails, right? It's pretty specific there. But it turns out the Wall Street experts in predicting interest rates over this pretty long period of time were only right 43% of the time. Whereas my favorite prognosticator, Yogi Berra, like to say, it was tough to make predictions, especially about the future. So as we're wrapping things up here for our call, the psychology of investing, I'm going to leave you with 3 final notes, and reinforcing that it's our proper behavior, right, as investors, that is critical to our overall investment success, that discipline that we're talking about. And there are common investor biases that are a challenge for everyone, right? Investors, financial professionals, etc. Envy, you know, that regret, that fear of missing out that we talked about. S&P envy, again, why that diversified portfolio never feels good, but ultimately is the winning strategy in the end. And then trying to avoid that lottery effect, right? That small investment for a big gain, right? The chance of winning is relatively small. From the loss standpoint, you know, compounding, the 8th wonder of the world. Remember, time in the market versus timing the market. And, you know, following the herd, right, is not necessarily the best idea. And working with Vlad and the financial advisors to build that discipline will help you, right, ensure that you're reacting to that market volatility rationally. You know, being critical, even when times are good, and be opportunistic, right, now, even when times seem bad. And on that note, we think from the emotional aspect of this challenging period, you know, save your emotions, you know, for the moments in life that really matter. Now this is our little heart tugging slide here at the end as we wrap up. And on that note, I'll invite Vlad to unmute his line and take us out.
Excellent. Michael, thank you very much. This was a wonderful presentation. And I know the quotes that you shared with us, I've said them probably, I don't know, 1,000 times. And it really is true. You know, you really need to be fearful when others are greedy, be greedy when others are fearful. You know, how many people are buying airline companies right now? How many people are buying Marriott's and Hilton's? And how many people are investing into cruise liners, right? We're not going out of business. And everyone's talking about, well, oil now is plummeted down. That's it. You know, Tesla is the way to go. Well, you don't exactly see cruise liners operating on batteries or planes flying out in the sky utilizing batteries, right? Well, the drones do, but yeah, I don't feel exactly comfortable, nor probably neither of you at this particular point to get into the drone that's piloted, you know, by someone on the ground instead of flying alongside with you. So anyway, there are plenty of opportunity, and know that we're here for you to answer your questions. And as always, thank you for allowing us to play a big part of your success. And have a wonderful afternoon. Michael, thank you, and I'll talk to everybody later. Bye-bye.